Okay, so welcome to the cost of capital reading. So far, when you've been discounting cash flows in previous readings, you have been using a discount rate that has been given to you. But where does the discount rate actually come from? How do we calculate it? That's what this reading is going to focus on. So essentially, it is the cost of capital of the firm. So let's think about our capital providers. We might have some debt holders providing debt finance. We've got shareholders providing equity finance. We might even have some preference shares. All these investors require a return, and the weighted average of that return that they require is essentially the cost of capital to the firm, and that's what we're going to use to discount our projects. And if the projects don't generate a return that is greater than our cost of capital, it's not worth doing that project, which is what we saw in the previous reading. So here we go, we've got a definition. The weighted average cost of capital, or the WACC as I'll refer to it from now on, is the overall opportunity cost of the firm's capital is a weighted average of the opportunity cost of capital from debt, preferred equity and common equity. And the project should be undertaken only if the return on invested capital is greater than its opportunity cost. Fine, we're good with that. Okay, so first of all, we need to be happy with the notation that you're going to see. KD is the yield on your debt. This is the return that the lender requires. Okay, now you've got to be a little bit careful with this, because that's the return that the lender requires and that's the return that they will get. However, from the company's point of view, and we are doing this from the company's point of view, the company will pay that interest, give that return to its lenders. However, remember, interest is a tax-deductible expense for a corporate. And so the actual cost of that debt finance is lower than the return that the lenders actually receive. So what we need to do is we need to take that yield and we need to take off from it the tax. So we're going to take the yield multiplied by 1 minus the tax rate to get the after-tax cost of debt. And that's the relevant input into our weighted average cost of capital. When it comes to shares, there is no tax advantage to paying dividends, and therefore the return that your preference shareholders require is the same as the cost of the preference shares to the company. Likewise, the return that your ordinary shareholders require is the same as the cost of the common equity to the company. So let's have a look at a weighted average cost of capital. We're simply going to take the weight of each security in our capital structure and then multiply it by its cost. So we've got an example here. Firm X has a target capital structure of 10% preferred stock, 45% debt and 45% common equity, and we're told that KD is 7.5%. So remember, KD is just the yield, so we want the after-tax effect of that, so we are going to have to multiply that 7.5 by 1 minus the tax rate, and we're given a tax rate of 40%, so that's fine. The cost of the preference shares is 9%, and the cost of your common equity is 11.5%. So simply taking a weighted average of that. So the 0.45, what's the 0.45? So that's my debt, 45% debt multiplied by the 7.5% yield multiplied by 1 minus the tax rate to get the after-tax cost of debt to the company. Plus we've got 10% of preference shares, which are costing us 9%, plus we've got 45% of common stock in our capital structure, which costs us 11.5%. So just multiplying and adding all that together, we get a weighted average cost of capital of 8.1%. And that is the discount rate that we are going to use to discount any project cash flows. Okay, what weightings should we use when we are calculating our WACC? Well, ideally, we are using the target capital structure. So we're looking at the proportions of debt, preferred stock, equity that the firm expects to achieve over time. So we're looking at a long-term capital structure. How do analysts determine the target weights? Well, they could just assume that the current weights are the target weights. They could adjust existing weights for firm trends. So for example, if we've seen that debt has been trending upwards over the last few years, we might assume that's going to continue. We could use industry average weights. In a question, if you aren't given the target capital structure and you are given the following, the existing capital structure, the firm trends or the industry average, then which one should you use to approximate for the target capital structure? Then actually the better one is you want to use industry average rates, because we can assume that over time our company should be fairly similar to the industry. Then this would be the next best one, and then finally we assume that their current weights are the best approximation for target. All right, marginal cost of capital. So what are we talking about here? Do you remember from economics, the word marginal means the next one. So the marginal cost of capital is the cost of an additional dollar of capital. It's the WACC for raising an additional dollar of capital. So for example, our current WACC might be 8%. But we now need to raise more capital because we've got a new project that we want to do. And because we're raising more capital and we're raising more debt finance, we are now more risky because we have more debt in our capital structure. So our lenders require a higher rate of return. So if the cost of debt finance goes up, then our weighted average cost of capital goes up. And so our marginal cost of capital is increasing as the firm increases the amount of capital it raises. Thus, the marginal cost of capital curve slopes upwards. Whereas our IRRs, if we're looking at our projects, then in terms of which project am I going to do first, I'm going to do the highest IRR project first. And then I'm going to do the second highest IRR project, then the third highest IRR project. So our investment opportunity schedule slopes downwards. Now, if we plot both the marginal cost of capital curve and the investment opportunity schedule on the same graph, we should hopefully be able to see what our optimal capital budget is. So we can see that on this next slide. So here's our y-axis, which is the project IRR if I'm looking at the investment opportunity schedule, or the cost of capital if we're looking at the marginal cost of capital curve. And then our x-axis is the new capital raised or invested. You can see here we've got our marginal cost of capital. So if I raise a little bit of capital, then that's how much it's going to cost me. And actually I can invest that capital in a project that is generating me this IRR. Should I do this project? Yeah, absolutely. The cost of capital is less than the IRR. I should take on this project. It's going to increase my shareholders' wealth. Should I do the next project? So if I raise more capital, you can see it's going to cost me a little bit more. And the next best project has a slightly slower IRR, but it is still worth doing. So I'm going to keep raising capital as long as the IRR is greater than the cost of capital. So here the IRR is greater than the cost of capital. So we are going to keep raising finance. Now, once we get to this point, if I raise another dollar of capital, then it's going to cost me this much, and the next best project available for me to do only generates this much return. Should I do it? No, of course not. The IRR on this side is less than the cost of capital. It's going to cost me more to raise the finance than I'm going to generate in the project that I'm investing that finance in. So I should stop. So I stop raising capital at that point, and that has identified my optimal capital budget. Okay, so let's have a look at the role of the WACC, or the marginal cost of capital. So the WACC is the appropriate discount for projects that have the same level of risk as the firm's existing projects. Right? Whereas if I'm going to invest in a project that is more risky than the company, then really I should take that risk into account by adjusting the weighted average cost of capital. I should actually make that weighted average cost of capital higher. I should increase the discount rate, discount those future cash flows at a harsher rate to reflect that this project is more risky than the average project that the company does. And vice versa. If I'm investing in a project that is below average risk, then fine, I can use a discount rate that is slightly less than the firm's WACC. So, where do those components come from? Where does the cost of debt come from? Where does the cost of the preference share come from? Where does the cost of the common equity come from? You might need to calculate these. So we said that the cost of debt, well, we're just going to take the current market yield to maturity And once we've identified the yield, we're just going to multiply by 1 minus the tax rate to get the after-tax cost of debt to the company. So for example, we have firm X here can issue new par debt at an interest rate of 7.5%. So hence, given that I know this debt is being issued at par, then the yield must be equal to the coupon. So that 7.5% interest rate must be the yield. If the firm has a 40% marginal tax rate, what is firm X's after-tax cost of debt? And we've worked it out for you, so there you go. Just take your 7.5% yield, multiply by 1 minus the tax rate, 1 minus 0.4, and we get an after-tax cost of debt of 4.5%. And it's the 4.5% that is then going to go into my WACC calculation. Okay, so where do we get the yield from? Well, if the firm's debt is publicly traded, then I can just look in the market and I can see what the yield to maturity is on the firm's current debt products, the firm's current bonds that are out there trading in the market. That would be the easiest way to do it. If the firm doesn't have publicly traded debt, then that's fine. I can still estimate the yield by taking into account the credit rating of the company. So if this company is single A rated, they're planning to issue a 10-year bond because this is a 10-year project, then I can look for a similar rated company, so another single A rated company, ideally that does a similar thing, so same industry. Try and find as comparable a company as possible, same credit rating, and I can look at their 10-year bonds trading in the market, and I can look at the yield that's required on those bonds and use that as an estimate for our yield. Likewise, for firms that use floating rate debt, again, I can estimate the cost of the firm's debt by looking at a yield curve, so same maturity, and looking at the firm's debt ratings. What about the preference shares? So the cost of the preference share is simply the dividend yield. Okay, that's what you've got here. You've got a preference dividend divided by the price of the preferred stock. So the maths is quite simple here. You've got a new non-callable, non-convertible preferred stock with a dividend of $8.50 and it has a value of $100 per share. What is the firm's cost of the preferred stock? Well, it's just the return that the investor requires, which is the dividend yield. And the dividend yield is dividend over price, so $8.50 divided by the 100, you get 8.5%. So that's fairly straightforward. We should be good with that. And then we move on to the cost of common equity. Now, there's a number of different ways to calculate your cost of equity. There's actually 3 ways you need to know in this reading. A couple of them you're going to see elsewhere in the syllabus. So if you have left this corporate finance reading till the end, then this will be a repeat, which is great. If you're seeing this for the first time, that's fine. I'll run you through the 3 different methods. So method 1 is known as the CAPM method, capital asset pricing model. And this is actually one of the fundamental formulas that you need to know for this exam. It comes up in a number of places throughout the syllabus, and therefore the chances are you're going to see it on the day of the exam. So I would make sure I know this formula. So what's CAPM saying? Well, the scenario here is, all right, I am a shareholder, I'm looking to buy a share in a company, let's say Walmart. I want to buy a share in Walmart. Well, what return do I require from Walmart? Well, I've got $100 to invest. I could invest my $100 in Walmart shares, or I could buy US government bonds. And US government bonds, I mean, I'm assuming the US government isn't going to default, so I'm assuming they are credit default risk-free. So at the least return I require is the return that I would get if I lent my money to the government, which we use as a proxy for the risk-free rate. So a little bit theoretical, the risk-free rate, but we can assume, you know, certain governments, not all governments, but certain governments are risk-free. So I want at least the return that government bonds are yielding, which let's say may be 5%. Now, on top of that, I want a little bit more because I'm not lending my money to the government, which is risk-free. I'm investing in equity, and equities equity is risky. So I want a little bit extra. So what I could do is I could look historically and I can see, well, historically the expected return on the market has been about 10%. And so if I then deduct the risk-free rate from that, I get the equity risk premium or the market risk premium, which is the extra that the equity market generates above the risk-free rate. So that would then take me up to 5 plus 5. I would require a return of 10%. Now the next thing I need to take into account is, well, actually this company may be more or less risky than the average company in the market. And so I need to take that into account. And beta takes into account whether this company is more or less risky. And you've got a definition here of beta. Again, beta is something you'll see elsewhere in the syllabus. Beta measures the systematic risk of the firm's stock. Think about it as measuring the how sensitive a stock is to changes in the macroeconomic environment. So if interest rates go up, if the economy is going into recession, all companies will be affected by that. Some might be affected more than others, and beta measures how sensitive the company is to changes in the macroeconomic environment. It measures its systematic risk. And so if beta is equal to 1, what we're basically saying is that the company has the same risk as the market. So therefore, if the S&P 500 was to go up by 10%, I would expect this company to also go up by 10%. If beta is equal to 2, then if the S&P goes up by 10%, I actually expect my company to go up by 20%, because this company is now more volatile than the average company in the market. I am more risky, so I will go up by 20%. Likewise, if we're in a recession and the stock market falls by 10%, I expect this company to fall by 20%, much more volatile. Or we can have beta of 0.5, in which case we're less sensitive than the market. Market goes up 10%, I expect this company to only go up by 5%. So that's what beta measures. And then I can adjust that to take into account the riskier the company, then the higher the return that I require. Everything comes back down to risk and return. So let's have a look at an example. So we've got the T-bill rate here is 5%, so we'll use that as our proxy for the risk-free rate. The expected return on the market is 11%, so that's my return on the market, and Firm X's beta is 1.1. Therefore, what does that mean? We are slightly more risky than the market. So just shoving those numbers into our CAPM formula, we've got the risk-free rate of 5 plus our equity risk premium, the little bit extra, 11 minus the 5, and then multiply that by the beta to take into account the systematic risk, and we get a cost of equity of 11.6%. And again, this will be a component of my WACC. I would then take that 11.6%, multiply it by the weight of equity, and add it to the cost of debt multiplied by the weight of debt, add it to the cost of preference shares multiplied by the weight of preference shares to get my overall WACC, my overall discount rate. So that's one way of calculating cost of equity. There is another method, and this is known as the dividend discount approach. And this is quite similar to the way we calculated the cost of preference shares. Remember, the cost of preference shares were just the dividend yield. Well, that's what we're doing here. We're starting off with the dividend yield. Dividend over price. We're looking at next year's dividend because remember, this is all about we're looking forward. So I'm taking next year's dividend and I'm dividing by the price. That's the dividend yield. Now, the thing with preference shares, preferred stock, we know they pay a fixed dividend. So hence why I could just take the dividend divided by price, and that was all I had to do. Whereas we're talking common equity here, ordinary shares, which I would hope my dividend is going to grow over time. So we need to take into account a growth rate. So we take our dividend yield and we add to it the firm's expected constant growth rate to get the cost of equity. Now, you might get given this year's dividend, but as long as you've got the growth rate, then your formula just becomes D0, grow it by 1 year to get D1, divide by the price plus G. Those of you that have done the equity reading, you'll have seen this formula already, but it was rearranged because you were trying to calculate the P, the price, in the equity reading. So you may have seen this before if you've covered the equity reading already. So there we go. What if you're not given the G? Well, you can calculate the G. And the formula there is the return on equity multiplied by the retention rate, which hopefully is quite intuitive. You can imagine the firm's growth rate is dependent on, well, how much of the profits do I retain? That's my retention rate. And then what return do I generate on those retained earnings? That's your return on equity. And if you multiply the two together, that should give you the growth rate of the firm. So that's just how the examiner can mix it up a bit, make it a little bit trickier by not explicitly giving you the numbers and you're just plugging them into a formula. You have to do a little bit more work. So just remember your growth rate, and you should have seen this formula before. This does come up in your financial reporting and analysis reading. The growth rate is return on equity multiplied by the retention rate. Okay, the third method, I'd be aware of this one. I don't think it's as important as method 1 and method 2. It's not one I've seen massively used in real life. We are simply taking the bond market yield and saying, well, equity is riskier than debt, so therefore let's just add a risk premium to that. What's the risk premium? We'll just pluck a number out of thin air. According to the reading, the risk premium normally ranges from 3 to 5%. So here we go. I know my bond market yield is 7.5%. I'm going to add a premium to that of 4% to take into account the fact that equity is riskier than debt, and I get a cost of equity of 11.5%. So it's, you know, a bit more of an imprecise calculation, this one, as it says there at the bottom of that slide. Okay, moving on. How do we come up with the cost of capital for a project? So it says here we're going to calculate the cost of equity for the project using the pure play method. So what's this about? We are going to take into account the risk of the project, which may very well be different to the risk of the company. So, for example, let's take Walmart. Okay, I believe everybody should have heard of Walmart. So Walmart are a big US supermarket. They sell a bit of everything, but they primarily started off doing food retail, groceries. So back in the day, okay, when they were primarily a big grocer, they would have made the decision to go into fashion retail, start selling clothes. And so when they were making that decision, and they were looking into, okay, well, let's analyse this project. What cash flows do we think we'll be able to generate by selling clothes? What should we discount those cash flows at? Well, the fashion retail market is very different and has very different risks to the food retail sector. So in order to get a discount rate, what they might have done was they might have said, okay, well, why don't we have a look at a company that is purely a fashion retailer? And so they might have taken Gap Inc. as an example of a company that purely sells clothes. So what we'll do, if I skip forward, I think this gives you a little bit more detail. What we'll do is we'll look at that pure play company, the company that purely does what our project's doing, i.e. Gap, and we'll take the beta of Gap, because that reflects the systematic risk of the fashion retail sector as opposed to the food retail sector, which is what our beta takes into account. So we're going to take Gap's beta. The problem is Gap's beta also reflects Gap's capital structure, Gap's current capital structure, their debt to equity ratio. So we need to strip that out. So we unlever the beta to get the unlevered beta or the asset beta. And then what we need to put back in is Walmart's capital structure. And that will then give us a project beta. And that is a beta that reflects the risk of the fashion retail sector. And it reflects Walmart's capital structure. And that's the beta that should be used in a CAPM calculation to calculate the cost of equity, which will then, the cost of equity will go into a WACC calculation. And that will give us the discount rate that reflects the risk of the fashion retail market. So how do we do that? So we're starting off with the beta for the pure play company. So the beta for the pure play company in our scenario is GAAP. And then we need to strip out the capital structure of GAAP. So we divide by 1 plus the debt to equity ratio, that's the capital structure of GAAP. So that's GAP's capital structure. And then remember, whenever you're doing anything with debt, there's that there's that tax impact of debt. So we always just take the debt, multiply it by 1 minus T. So you're dividing by 1 plus the debt to equity ratio, and just remember to multiply the D by 1 minus T. And that gives us an unlevered beta, or also known as the asset beta. Okay, what we now need to do is put back into that beta Walmart's debt to equity ratio, or Walmart's capital structure. So this debt to equity ratio here is for Walmart. And remember to strip out GAP's capital structure, we divided by 1 plus the debt to equity ratio. So now to put back in, we're multiplying by 1 plus the debt to equity ratio of Walmart, and as always, multiply the D by 1 minus T. And that then gives us the beta for the project. So that is a beta that reflects the systematic risk of the fashion retail sector, and also now reflects the risk of Walmart's capital structure. That beta can then go into a CAPM calculation to give us the cost of equity, and then that cost of equity can go into a WACC calculation so we can get the overall discount rate for the project. Okay, moving on. Another issue we might have. What if we are undertaking a project in a developing market? Then developing markets are riskier than developed markets, and therefore we should take that risk into account as well. So the solution to this is we add a country risk premium to the market risk premium when using CAPM. So we're doing our bog standard CAPM calculation, but, and this is the key point, inside the brackets, okay? You will make a mistake if you add the country risk premium outside of the brackets. It's a schoolboy error that I have seen delegates do before. So make sure you are putting it inside the brackets. You add that country risk premium. Now, where does the country risk premium come from? How do you calculate it? Well, we've got a formula here. So the country risk premium is simply the sovereign yield spread. So we're going to start off looking at government bonds in the developing market and in the developed market. And actually, this spread, the bonds need to be denominated in the developed market currency. So you've got that actually written on the slide down here, because that's quite an important point. So let's imagine we're looking at Brazil as our developing market, and our developed market is the US. So what we would do is we would take Brazilian government bond yield, but those Brazilian government bonds need to be denominated in dollars, in US dollars. And if we take away from that our US government bond yield, again also in dollars, to get our sovereign yield spread. So that takes into account the extra return that is required in the bond market. But we're not talking bonds, we're talking equity, and equity is riskier, more volatile than the bond market. Therefore, to take into account the additional risk of equity, I multiply by the annualized standard deviation of the equity index in Brazil, divided by the annualized standard deviation of the sovereign bond market in terms of the developed market currency. So by the volatility of the Brazilian government bonds denominated in US dollars. And we've got an example here for you with some numbers, but we haven't told you where those numbers are coming from. So why don't I quickly scribble those down? If we imagine, well, actually, let's just imagine, so that's my Brazilian government bond yield. In dollars. So I've looked in the market, and Brazilian bonds denominated in dollars are yielding 9.2%, whereas US government bonds, again dollars, are yielding 4.7%. So that's the extra return that bondholders require if they're lending money to the Brazilian government versus the US government. And then taking into account the standard deviation of the equity market in Brazil, divided by the standard deviation of the bond market in Brazil. So you would be given all those numbers in a question and you're essentially just shoving them into this formula. Although notice this is a describe learning outcome statement, so you know this hopefully isn't going to be numbers, but we've given you the numbers just to illustrate. So that gives you the 8.5%. And then put it into your CAPM formula. There's your risk-free rate. That would be the risk-free rate in the US plus the beta multiplied by, that would be the expected return on the market minus the risk-free rate plus the country risk premium, and it's all inside the brackets, giving you a cost of equity of 23.14%. And again, that cost of equity would go into a WACC calculation to give you an overall discount rate for the project. Okay, marginal cost of capital. So we've already said this, it's the opportunity cost of an additional dollar of capital. As the firm raises more capital, then they'll be raising more debt, and it could be that the debt holders now require a higher return. The equity holders now require a higher return because there's more financial risk now because we've got more debt. And so we've got the upward sloping marginal cost of capital curve that we saw earlier. So it's what we saw before with the, there you go, that's your upward sloping marginal cost of capital curve. There's your downward sloping investment opportunity curve. But what we're showing you, instead of showing you a smooth line, we're showing you the breakpoint. So if I just get rid of that. So as long as I am raising finance up to this point here, we're good. My cost of capital stays the same. But if I raise that next dollar of finance, then all of a sudden my investors now want a slightly higher return because I've raised that much more capital. And so my WACC jumps up. And those points, so here and here and here, these are known as breakpoints. And you might have to identify where the breakpoints are. So how do we do that? Well, you've got a definition here. So the amount of new capital investment at which the WACC increases because one of its component costs of capital increases is termed a breakpoint. And here's your formula here. It's the amount of capital at which the component's cost of capital changes divided by the weight of the component in the capital structure. So if it's debt that's driving this, if I raise up to $1 million worth of debt, then investors require a yield of 7%. But if I raise more than $1 million, well, now they think I'm a little bit riskier, so they require a return of 8%, then that's the amount of capital at which the component's cost of capital changes, the $1 million. And then I need to divide that by the weight of the component to then get the total capital investment at that breakpoint. So let's have a look at an example. Here we go. So we're told our cost of debt increases past $1.5 million. Debt is currently 30% of the target capital structure. Therefore, my breakpoint is I take the 1.5 million divided by 0.35 million. So what that is telling you is that if you are raising a total of $5 million, then 30% of that $5 million is going to have to be debt if you're keeping your existing capital structure. And 30% of $5 million is 1.5 million, which is where your cost of capital changes, which is your break point. All right, so that's what that formula is doing. There we go. When over $5 million is raised for projects this year, the marginal cost of capital increases. Okay, so moving on, we've got a little bit on flotation costs. So flotation costs, this will be the fees that you are paying to your investment bank for doing the share capital issue for you. So this could be IPO fees potentially or follow-on offerings, and they can range from 2% to 7%. So pretty significant. So how do we deal with these IPO fees? They are a cost of raising the finance. So I need to take them into account in my project cash flows. Now, I could just, let's say the fees are 7%, I could add those 7% to the cost of capital. But that would be wrong, okay? So you need to know that just adding the percentage to your cost of equity, that's the incorrect way of doing this. You're then carrying that cost throughout the life of the project. And actually, the best way to deal with IPO fees is think of them as an initial cash outflow. So take your cash flow at time zero, your initial cash outflow, and include flotation costs to that as well. So if your project is 100 million, then you've got your cash outflow of 100 million, and then on top of that, you've got to pay 7 million to the bankers for raising the equity in the first place. So your initial cash outflow is 107 million. Okay, that's the way to deal with flotation costs. So if you see a question with flotation costs in it, just add them to your initial cash outflow. And that is it on the cost of capital reading.